So iron just spiked, plus 9.54% yesterday,
Right.
closing at $43.07. But honestly, beneath that immediate rally, the broader picture is just, it's intensely complicated.
Oh, absolutely. It's a mess.
Because short sellers are piling into the stock, and you've got these really bearish signals flashing on the daily charts.
Mm.
And then Wall Street analyst targets are swinging wildly. I mean, from a doomed $12 projection all the way up to a sky-high $153.
Which is an insane spread, by the way.
It really is.
Yeah.
So it begs the question for you listening today. Is this stock a generational strong buy, or are we just looking at a very, very dangerous value trap?
Yeah, and the divergence in those numbers tells you really everything about the tension surrounding this company right now.
Exactly.
What you see depends entirely on whether you're looking at the brutal reality of their balance sheet today or, pricing in these massive technological promises they're making for tomorrow.
Right. Well, welcome to this deep dive into IREN Ltd. We're going to unpack the financial data, the chart technicals, and the insider trading reports.
To try and make sense of what is actually happening under the hood here.
Yeah, exactly. But before we get into the mechanics of all this, just a crucial disclaimer. We are here to analyze the provided data and debate what the numbers suggest.
Right.
This is an exploration of the information. It is absolutely not financial advice.
Yeah, we're just looking at the facts on the table, explaining the underlying mechanisms behind them so, you can draw your own conclusions.
Exactly. And hey, really quickly, please make sure to like the video and subscribe to our YouTube channel.
Yeah, and definitely leave your thoughts and feedback in the comments. It is compulsory. We want to hear your verdict by the end of this.
Yes, we do. So let's start with the core conflict here. Because IREN is a company suffering from a massive, incredibly expensive identity crisis.
That's probably the best way to put it, yeah.
They're attempting to pivot from being purely a Bitcoin mining operation into an AI cloud infrastructure powerhouse.
What they like to call an AI neocloud.
Right, an AI neocloud.
Yeah.
And that transition is the lens through which you have to view, every single financial metric we're going to discuss today.
Oh, 100%. To understand the wild price swings in the stock, you first have to understand the sheer friction between how they make their money right now and what they desperately want to become in the future.
Okay, so looking at the top-line income statement, it actually seems explosive. Total revenue is sitting at $757.1 million over the trailing 12 months.
Which is huge.
Yeah, it's a massive jump from the $501 million they reported in fiscal year 2025, and it's flowing down to the bottom line, too.
Right.
Net income over that same trailing 12-month period is $389.7 million, with diluted earnings per share at $1.44.
Yeah, and we also need to look at their EBITDA, which sits at $237 million.
Okay, break that down for us real quick.
Sure. So if we strip away the taxes, the interest, and the depreciation of their equipment, looking purely at the cash their core operations generate, they're pulling in a very healthy $250 million.
Wow.
Yeah, on paper, those are the metrics of a highly, highly profitable enterprise.
Right. And the balance sheet as of December 31st, 2024, shows they were sitting on $1.85 billion in total assets. That includes $427.3 million in cash and equivalents. But, and here is where the math stops making sense to me, if they have nearly $500 million in cash.
Yeah.
And they generated over $245 million purely from operations in FY 2025. Why is their debt-to-equity ratio sitting at a dangerously high 153%?
It's a great question.
How are they pulling in that much cash yet drowning in that much debt? It's like a company perfectly flipping a mansion but still throwing raging, destructive parties inside it at the same time.
That's a great analogy. And the friction there really comes down to the sheer scale of the capital expenditure required to build an AI neocloud.
The hardware costs.
Exactly. They aren't just buying a few racks of standard enterprise servers. IREN is trying to procure massive quantities of highly specialized NVIDIA GPUs.
Right, the really expensive stuff.
Oh, yeah. These are top-tier chips that cost tens of thousands of dollars a piece. And they need tens of thousands of them.
So the operational cash flow, as strong as it is on paper, just cannot keep pace with the massive upfront costs of buying the hardware for this AI transition.
Not even close. The cash generation is basically a drop in the bucket compared to the billions required to build out this new infrastructure.
Wow.
Yeah, they're taking on massive debt to finance a vision that hasn't fully materialized yet. The gamble is that future revenue from renting out these AI clusters will eventually outpace the crippling interest and debt obligations they're securing today.
Okay, well, that explains why the market is treating the stock like an absolute battlefield. The trading reality right now is extreme.
Yeah, the volatility is wild.
Right, like the 52-week range is incredibly wide, dipping as low as $5.24 and rocketing as high as $76.87.
Insane swings.
Yeah, and currently the stock is trapped in this high volatility consolidation phase, kind of just bouncing between $30.76 and $45.35.
And the technical indicators reveal a lot about how institutional investors are viewing that debt burden versus the AI potential.
What are the charts saying right now?
Well, right now, the trend direction is mixed, leaning slightly bearish. The stock is actually trading below its 50-day simple moving average, but above its 200-day simple moving average.
Okay, let's break down what those moving averages actually tell us about the momentum here.
Sure.
Being above the 200-day moving average usually signals that the overarching long-term trend is still intact, right?
Exactly.
But failing to stay above the 50-day moving average suggests the immediate medium-term momentum is dragging the price down. It's like we've got the long-term horsepower of a sports car.
Right, because we're above the 200-day.
Yeah, but we're currently stuck behind a tractor in the fast lane because we're below the 50-day.
I love that. Yeah, moving averages show us the footprints of institutional capital. The 200-day represents the baseline for long-term holders. They haven't abandoned the stock entirely,
Right.
but that 50-day falling overhead acts as dynamic resistance. It means that over the last 2 months, the dominant pressure has been selling, effectively capping any rallies before they can gain serious traction.
And the other technical indicators reflect that exact same traffic jam, right?
Yeah, pretty much.
Because the relative strength index, the RSI, is sitting at 51.38. That is perfectly neutral, neither overbought nor oversold.
Dead center.
And meanwhile, the MACD indicator is barely positive at 0.33.
Right, and for those of you tracking the charts, the MACD, the moving average divergence, is essentially a measure of velocity.
Okay.
So a reading of 0.33 tells us there is technically an upward push, but it has almost zero force behind it. The momentum is just flatlining.
So we have key support holding the floor at $34.76 on the weekly chart and $32.41 on the daily. And looking up, there's an immediate resistance zone around $41.54, with a major heavy hurdle at $45.45. If the stock cannot break through that $45 resistance, what actually happens next?
Well, the chart is flashing a very alarming signal regarding that specific scenario. Analysts are pointing to what's called a hidden bearish divergence at the daily pivot.
Okay, wait, I want to unpack that, because hidden bearish divergence sounds like Wall Street jargon for impending doom.
It kind of is.
What is the actual mechanism happening in the order books when that signal flashes?
So a hidden bearish divergence occurs when the price of the stock is making a lower high, but the underlying momentum oscillator is making a higher high.
Okay, so mechanically, what does that mean?
Mechanically, it means the buyers are putting in more effort and using more momentum just to push the stock to a lower price point than the previous rally.
Oh, wow.
Yeah, it's a sign of complete exhaustion. The underlying buying pressure is failing despite surface-level appearances.
So if that $45 resistance holds firm and rejects the price, this technical exhaustion suggests the floor could just completely fall out.
Exactly. The technical weakness suggests there is a very real downside risk all the way back down to $26 if those key support levels at $34 break. Yeah, the lack of buying velocity means there isn't enough demand to catch the falling knife until it hits that much lower valuation.
I mean, a drop from the low $40 down to $26 is a brutal haircut for anyone holding the stock right now.
Absolutely brutal.
And this brings us to the great value trap debate. Because professional Wall Street analysts are looking at this exact same chart, this exact same balance sheet, and their conclusions are wildly fractured.
Yeah, the spread in analyst targets for IREN is one of the widest I've seen in the current market.
Let's look at the consensus data. Out of 22 analysts, there is an 80% moderate buy rating.
Which sounds great.
Right. The average price target is $74.38, which implies an 89% upside from current levels. But the valuation models underneath that average are just pure chaos. The lowest target is $29, and the highest target is an astronomical $136.
Right, and the divergence in those models basically comes down to how they treat terminal value and execution risk.
So the bear's warning of a value trap point to models claiming the intrinsic value of the company based strictly on current fundamentals is only $12.29. Right. meaning at $43, it's 69% overvalued right now.
Yeah.
But then you have the long-term models factoring in future AI cash flows, giving it an implied equity value of $153.29, meaning it's 62% undervalued.
It's wild.
How can professionals look at the exact same data and be $140 apart? Are we buying the company it is today or the company it hopes to be in 5 years?
That is exactly the dividing line.
Yeah.
The analyst generating that $12 valuation is applying a strict present-day discounted cash flow model to IREN's current operations.
Right.
They see a company heavily exposed to the volatile crypto market, bleeding cash to buy hardware, and carrying a 153% debt-to-equity ratio.
So they're looking at the debt.
Exactly. In their model, the AI revenue is unproven. They are pricing the company based on the severe risk of its current debt obligations.
And the analyst projecting the $153 valuation.
They are extending their discounted cash flow model 5 to 10 years into the future. They're treating IREN as a foundational monopoly in the AI revolution.
So they're pricing in the future monopoly.
Right. They're taking those future high-margin neocloud revenues and discounting them back to the present day. To them, the massive debt and the current cash burn are just the temporary cost of admission to dominate a sector that will define the next decade.
Okay, but when the models are this divided, you really have to look at what the people with actual skin in the game are doing with their capital.
Always follow the money.
Exactly. And the short interest data is aggressively bearish right now. As of March 31st, 2026, there are 55.88 million shares sold short.
Wow.
Yeah, that is 17.7% of the entire tradable float. And it marks an 8.2% increase in short bets recently.
So almost a fifth of the stock's available volume is actively betting that the company will fail to execute its pivot.
Right. And then we have the insider selling. On September 11, 2025, the co-CEOs and directors unloaded over 3 million shares at various price points.
Yeah, that's a red flag for a lot of people.
Let me play the skeptic here. If the Wall Street consensus is an 80% buy rating, and the upside is supposedly 89%, and the AI future is worth $153 a share, why are the co-CEOs dumping millions of shares into the open market while retail traders are getting trapped?
It's a fair question, and it speaks directly to the massive execution risk of this AI transition, which, honestly, insiders understand better than anyone.
Right.
Building a liquid-cooled data center at the scale IREN is attempting is not just about plugging in faster computers. It requires incredibly complex plumbing, thermal dynamics engineering, and massive upfront capital.
So they know that one major engineering setback, or even just 1/4 of missed revenue, could trigger a massive debt crisis.
Exactly. Insiders hedge their bets because they are hyper-aware of how fragile the timeline is. Meanwhile, the short sellers are looking at that insider selling, combining it with the massive debt and the reliance on crypto mining, and concluding that IREN will simply run out of cash before they can finish building their neocloud.
Right. We need to weigh both sides of this debate fairly. We've seen the massive debt burden, the precarious technicals hinting at a drop to $26, and the executives reducing their exposure.
Yeah.
Let's lay out the ultimate bear case versus the ultimate bull case.
Okay, so the bear case is anchored by two massive structural threats to the company's survival. The first is capital dilution.
Right.
Because they're burning so much cash to procure these NVIDIA GPUs, they rely heavily on at-the-market or ATM equity programs.
Let's explain the mechanics of an at-the-market offering real quick, because it is basically the silent killer of retail portfolios.
It really is.
It means the company is continuously creating new shares of stock and trickling them directly into the open market through a broker to raise cash.
Yeah, and the constant selling pressure of an ATM execution acts as a hard ceiling on the stock price. Every time the stock tries to rally, the broker just sells more newly printed shares into the bid. It artificially suppresses the momentum while actively diluting the ownership percentage of existing shareholders.
It's like the company is selling off the deed to the data center brick by brick just to afford the servers they want to put inside it. Your ownership stake shrinks with every new share they print.
That's exactly what's happening. Now, the second anchor in the bear case is the crypto reliance. Because despite all the sophisticated rhetoric about the AI neocloud, the reality is that 97% of IREN's current revenue still comes from Bitcoin mining.
Wow, 97%. That is a staggering vulnerability. It means they're trying to build a stable, enterprise-grade cloud infrastructure on a foundation made of lottery tickets.
Yeah.
If the price of Bitcoin crashes, their operational revenue just dries up instantly, regardless of how many GPUs they've managed to install.
They are completely tethered to the extreme volatility of the cryptocurrency markets right now. If that revenue stream fractures while they're holding 153% debt to equity from the AI build-out, The company could face an existential liquidity crisis.
Okay, that paints a pretty grim picture.
Yeah.
What is the fundamental bull case that justifies an 80% buy rating and those multi-billion-dollar future valuations?
Well, the bull case rests entirely on one asset that money cannot easily buy, and that is power. IREN holds 2.91 gigawatts of grid-connected power capacity.
Okay, 2.91 gigawatts is an unfathomable amount of electricity. That is enough to power millions of residential homes.
Exactly. And in an era where AI data centers are facing severe global energy shortages,
Hmm.
having nearly 3 gigawatts of secured grid-connected power is an impenetrable economic moat.
Because competitors can't just buy that.
Right. Competitors can raise capital by GPUs, sure, but they cannot simply conjure utility-scale power. Getting regulatory approvals, upgrading grid transformers, and securing that level of power capacity takes years, sometimes over a decade.
And IREN has already secured it, which I guess explains the recent $9.7 billion deal they scored with Microsoft.
Exactly.
That isn't just revenue, that is top-tier industry validation. Microsoft is essentially partnering with them because Microsoft needs that power capacity just as badly as anyone else.
Yeah, that Microsoft deal is the ultimate proof of concept for the bulls. The long-term goal for IREN is to scale up to 150,000 GPUs, aiming to hit a staggering $3.7 billion AI revenue target.
Wow.
And they're utilizing incredibly complex liquid-cooled data centers, primarily at their massive Prince George campus.
Let's touch on why liquid cooling is so critical. Because the new generation of AI chips runs so hot that traditional HVAC air cooling simply fails.
It just doesn't work anymore.
Right. You have to pump liquid coolants directly through the server racks to keep the silicon from literally melting under the computational load.
And the engineering required to operate a facility like that at scale is daunting. But if they pull it off, they possess the grid power, the cooling infrastructure, and the hardware to be an untouchable entity in the AI cloud sector.
So zooming out, this entire situation is a race against time. Can they use the volatile profits from their crypto mining side hustle to physically build out a $9.7 billion AI infrastructure before the crushing debt and the constant stock dilution from the ATM offerings swallow the company whole?
That is the tightrope they're walking right now. The best case scenario is they successfully execute the Prince George campus transition, the Microsoft capital flows in, and that 2.91 gigawatt power capacity cements them as an AI monopoly.
And in that timeline, the $153 valuation becomes a reality.
Exactly.
But the worst case continuation lower.
The worst case is that a major Bitcoin correction wipes out 97% of their current revenue. Suddenly, they're drowning in debt from the GPU purchases.
Oh, man.
Yeah, and to avoid defaulting, they're forced to aggressively ramp up their at-the-market offerings, diluting the stock into absolute pennies just to keep the lights on, wiping out current shareholders in the process.
All right, let's synthesize this final outlook for you listening. In the short term, you are watching that high volatility consolidation zone between $34 and $45. If institutional buyers step in and we get a confirmed breakout above that $45 resistance, it could trigger a rapid rally up toward the $55 level.
But if they fail to hold that $34 support level, and that hidden bearish divergence plays out as order book exhaustion, a brutal technical drop down to $26 is highly probable.
Long term, this is the very definition of a high-risk, high-reward play. It is a massive bet on a company attempting to deploy 150,000 GPUs without bankrupting itself during the transition.
The turbulence between today's debt-heavy reality and tomorrow's AI neo-cloud vision is going to require an absolute iron stomach from anyone holding the stock.
We have covered the debt structures, the technical exhaustion on the charts, the insider selling, and the incredible scale of their 2.91 gigawatt power moat. But here is the real question to chew on as you evaluate this data for yourself.
And this is the big one.
If IREN successfully builds the infrastructure for the AI revolution and they become the technological powerhouse they want to be,
Right.
but they have to execute endless at-the-market offerings and dilute their stock to pennies just to afford it, who actually wins? Does the company win, or do you, the shareholder, end up paying for a victory you don't actually get to share in? We want to know your verdict, so let us know in the comments. Thank you for joining us on this deep dive. We'll see you next time.